Okay.
I
But
watch
you
I
you're
watch
follow.
YouTube videos.
Okay. That's fine. So you're cool now. Yeah, well explained, right?
Yes.
Okay. That's fine. All right. Good evening, everyone, and you're welcome to another edition of our lecture on business valuation. Right? It's an interesting topic because it is practicable. It is what people honeymoon. Okay. Oh, Kudus, say welcome back from your honeymoon. Aisha, how are you? Good evening. So it is an interesting topic, right? So the only part we are yet to treat is the part of discounted cash flow, and I think I have a question on that. Discounted cash flow, right? Discounted cash flow. Then any other thing that you need to know, maybe that part of it. When we start our intensive class, for those who will join us, I think I have to bring question on it. I did that, then combine everything together. It's, so for those who will actually who will continue with us in intensive, right? So into this class, we shall look at more question on valuation of a business, more questions on valuation of business. So please, apologies that I'm yet to send the notes immediately after this class, or not before the next class, which is 8:30, right? So I will send the notes. I think I'm done with questions. I think I have about 5 questions here. And don't forget, there is also a written there in valuation of a business. Look at it here. Efficiency market hypothesis. So I will not come to this class and explain efficiency market hypothesis to class. You have to go and read efficiency market hypothesis. It's an interesting topic on that valuation of a business as well. But you understand it because you already have the knowledge of the valuation of a business, the cost of capital, right? The cost of capital, the objective of a financial manager, right? So please, you read on this efficiency, right? Market hypothesis. Please, you read on it. So into this class, let's I have 2 questions to solve before we go. Which question should I solve? Okay. Now, question four. Question four. Class, let me quickly do a quick recap here. You should not forget that why do you carry out evaluation of a business? It is because maybe a company want to merge or you want to acquire or you want to acquire another business, right? You have to carry out evaluation. However, when you want to merge with company B, you must have the reason. There must be a reason why you want to merge with Kudus. There must be a reason, right? Why you want to merge. And I mentioned some of the reasons in our previous class that you will need to carry out evaluation when you want to merge or acquire a business. And why do you want to merge? It is because of what we call synergistic benefits, because of synergy. 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 Because of the benefits. And what are these? With the intention that if I merge with Kudus, I will have what we call a revenue synergy. What is revenue synergy? When you combine Kudus and Abib together, company together, there will be an increase in the revenue. There are different type of synergy. There's a revenue synergy and there is cost synergy. Maybe the revenue will increase. That is why you want to merge. As a result of that, your costs will also reduce. And that is why you have to, one of the benefits of merger, because you look at it, or because in the non-financials, competitive advantage, access loan, maybe you may not, because you are operating as a non-listed company or a non-PLC company, because this person is a listed company in the world, in the stock market. You can quickly do what we call right issue. Benefit, access to quick money, quick finance, and so on. So when you migrate from FM to SFM, we'll still discuss the practical approach to merger and acquisition. Merger and acquisition is a topic on its own in SFM. You will get there, right? You get there. So what I'm trying to explain that it is part of the reason why we value business, and so on and so on and so forth. Don't forget, the question we always tell you that what will be the maximum price? What will be the minimum price? What will be the this that this person will pay for this particular company? And that is the valuation of a business class. And there is what we call intrinsic value. Okay, no, should I explain? Okay, there's what we call, let's just talk first. There's what we call, Alaide, do you want to take us? Alaide?
Sorry, it's my screen. Sorry.
Right? Now, this required question 4. What is the maximum amount Lekki PLC should pay for KPLC? Right? What is the maximum amount Lekki PLC should pay for KPLC? Meaning that we don't know what actually happened. We know that, we want to determine the maximum price. B, what price are KPLC shareholder likely to accept? What price are KPLC shareholders likely to accept? What are they going to accept? Right? Now, illustration. Lekki PLC wishes to acquisition now. To acquire the entire share capital of KPLC. Right? To the entire KPLC. Details of current earnings and PE ratios are as follows. Lekki want to acquire, that is acquisition. It is still one of the reason why you value business, because 100% acquisition, we have the earnings for Lekki, then the earnings for KPLC, then the PE ratios. 20%, 20, they have 20, you have 15. It is believed that as a result of synergies, synergy means that if you had A and B together, it will give us 5 because of their weight. Because of their weight, the combined earnings of the synergies would be, don't forget, revenue synergy is part of the types of synergy. So if Leke acquire KPLC, it will lead to a combined earnings. Combined earnings means that the two of their earnings together will becomes what? 75. Can you see the reason why I say 1 plus 2 is equals to 5? 75. But if Leke before earnings is 50, KPLC is 20. If you add them together, do you have 75? No, you don't have 75. And that is one of the reasons why you have what we call revenue synergy, a combined earnings. If you had their earnings together combined, we have 75. And the market would apply, what? A P ratio. P ratio of 18 to the combination of the combined company. Then what is the maximum price that Leke PLC should pay for KPLC? Do you know what you will do? The first step 1, determine the value of the company, of the combined company. What will be the value if we are to, if you are acquiring the whole company? What will be the value of you and I combined together? Step 1. Step 2, for you to calculate the maximum amount, is for you to calculate the value of KPLC that you want to acquire. Now, the difference between the value of the combined and the KPLC, we give you the maximum amount. Class, we give what? The maximum amount. Now, so this is a solution. Excuse me. So this is a solution. Step 1, when you're faced with this case scenario, because it is an acquisition, determine the value of the combined company. That is, what will be the market value of the combined company? The value of the combined company. Then, when you want to determine the value of a combined company, it is their earnings, the earnings of the combined, the earnings of the combined. So you do what? Earnings of the combined company. That is earnings. They say earnings is a profit after tax. That will be their earnings times the PE ratio of the combined company. Times the PE ratio of the combined company when you are faced with acquisition and you need to determine the maximum price that Mr. A will pay for B. The first thing you need to do is to determine the earnings of the combined company. Now, sometime, okay, let me finish this first. I will use some advanced approach in the second case scenario, right? Now, determine the value of the combined company. The earnings here is profit after tax of the combined, meaning that if you acquire everything, it will lead to what we call revenue synergy. Profit. And you can see that if it is individual, Leke has PLC 50, KP, you can see that it is not even up to 75. If it is individual. So 75 million times, what is the PE ratio of the combined company? What is the PE ratio of the combined company? 18. 18 given to us in the question. What is the value when you multiply it? What do you have?
1,350.
1,350. Step 2. Step 2. Determine the value of the target company. Let me use that language, right? Of the target company. Thus, the company you want to acquire is a target company. Class. So, what will be the value of the target company? Just like the way we did for the combined, you still have earnings of the target company. You multiply it by the PE ratio of the target company. Right? P ratio of the target company. So what do we have? What is the earnings of the target company that they want to acquire? What is the earnings? What is the earnings, class?
20 million.
20 million.
20 million.
20 million is the earnings.
Thank you. Times 15. So we can have here 20 times 15. What do we have?
300 million.
Now 300 million. Class. You should not forget that The value here include the two company, both the target company and the main company. Who is that? The person should mute his or mic, please. Both the target company and the main company. This N is here, right? So you need to remove the value of the target company from here. So when you remove it, you will now have the amount at which you will pay for Lekki PLC class. This is a combined, both the main company and the target company. Now, for you to know how much you will pay, you need to remove the value of the target company first. The market value, the value of the company, the value of the company, right? So when you remove it, what do you have? When you subtract this,
1,000.
Naira.
no, if you multiply 20 times, this is 20, right? I'm coming. Where is Lekki? Okay, sorry. Okay. So, okay. Now, you have for the combined company here, which is this. Now, and you have been approached that how much Lekki will now pay for it. What we're supposed to do is to remove the value of Lekki. Lekki, yes, Lekki. I think I wrote Lekki now. Yes, Lekki. I'm supposed to remove the value of Lekki PLC from the total. So the balance will now give us the amount at which what is it called? At which you cannot pay for KPLC. Right? So we can have 50 times 20, 50 times 20. What do you have here? What do you have?
1,000,000.
1,000. 1,000. So what do I have? The maximum. What is the maximum amount?
350.
To now be 350.
So the maximum amount that Lekki will pay will just be, this is the maximum it can pay. This is the maximum amount it can pay. Now, how do we arrive at P ratio times earnings? You should not forget that our PE ratio is usually profit after tax, which is earnings divided by the market price class. So we now say the market price or the market value, right? Or the market value equals to the PE ratio times the earnings, which is profit after tax. That is what we use here. The concept of PE ratio. And we have this given to us. Right? The same thing applicable here. Right? Of the what? Of the main company. The main company. So remove it. How much will now is the difference is the maximum amount you can pay for the acquisition. this will be the maximum amount that you can pay for the acquisition using the concept of PE ratio. When you are faced with acquisition question like this, the first thing you need to do is to determine the value of the combined company. And the value of the combined company in this question, they just want to make it easy for you, right? The value of the combined company would have used the total of the two earnings times the average PE ratio. But we're given the earnings of the combined times the PE what? The PE ratio. That is why we have the market value of the combined company. So what you need to do is that remove the market value of the main company. When you remove it, you have the maximum amount that you can pay for KPLC. In advanced level, or maybe yes, in advanced level, this 75 million of the combined company will not be given to you. Then the examiner will now ask you to use all this free cash flow, but that one is another alternative, right? So in another case scenario, this will not be given as the combined company. But what will you use? What are you going to use to determine the value of a combined company? Is their earnings. You cannot add the two together. There are two earnings together times the average PE ratio given to you in the question. We give you the value of the combined company. Then you will now remove the value of the main company. Once you subtract it, you will have the maximum amount that you can pay for that what? For that particular what's it called? For that particular company. And that is how we so the maximum amount that Leke we pay for, so the maximum, the highest amount that you could pay is this. This is the maximum amount, right? Why the minimum amount is the other way around. So I think I've answered question A, right? Thank you. So who have question for me? Quickly. You can unmute your mic quickly.
Okay,
If you have question,
sir.
unmute your mic.
Good evening, sir.
Olivia.
Okay, you said for the step 2, I have to calculate the value of the company in one.
Rejoice.
Yes, sir.
Your hand no dey pay you. Your hand is up now.
Yes, I'm talking now. I'm talking now.
Is it?
You said step 2, we should calculate the value of the company you want to acquire, and the formula you said is earnings of the target company. And now we're not using the company that wants to acquire like the other company. Should I call it the target company here? So are we going to change that formula now? Earnings of the target for company, is it going to change? Hello, it's my network. Hello.
I don't know. We can hear you. Can hear you.
Okay, I don't know if my question is understood from the
We can
formula
hear
you
you,
gave to
Rejoice.
us.
Yes, you're
Okay.
very understood. That is same. I have that same question too. So let's wait for you.
Okay.
You said what?
Okay, sir. I was asking in terms of the
I
formula
can't
you
hear
gave us.
you.
Can you hear me now?
Oh,
Voila.
just hold on. Just hold on.
Okay, sir.
Okay, go ahead.
Okay, so I was asking in regards to the step 2 and the formula you gave in getting the value
Mm.
of the target company. The
The
formula you
main
gave us is,
company,
and you said
yeah,
the
main company.
earnings of the target company. Please, can you now like give
His
us
main
the
company.
okay earnings of the
His
main
main company.
company? Okay.
Yes. Yes, the concept at which they use. You know how we arrive at this times this now. Do you know? You sure you know now?
Earnings
This
of
is
the
the
main
concept.
company.
Yes, this is the concept. The PE ratio. This is the concept that we use now. Is that not so? The
Yeah,
PE equals to profit after tax divided by, so
market
you
price.
change it, market price, but this is value. Market value times the profit after tax. The profit after tax is earnings, and this is the earnings here. Is that not so?
Yes. Okay. Understood.
Okay. Thank you. Any other question, please? Okay. Okay.
Hello, sir.
I'm with you.
Good evening, sir. Sir, I want to
Good evening.
ask that in the exam, if you are not given the total earnings of the two companies, like we have it as 75, what are we going to do to get the earnings of the
That's
two companies?
that's how I've explained. I've explained. Are you in this class? I've explained though. Please pay attention, please. I've explained that part. That in a situation whereby you're not given this as the combine, and you need to determine the value of the combine, add the profit after tax of this, add the profit after tax of this, add it together. The average PE ratio given to you in the question, multiply it, which will give you the value of the combined company. Then just remove Leke. Just remove the value of Leke from it. When you remove it, it will give you the maximum amount at which they can pay for that particular what? For that particular company. Right? Do you get? Do you get?
I don't understand.
You don't understand? Okay. You understand later. Thank you. So, um, where did we stop? B. Some of you will be in class and will be doing something else. Then later you explain, you say you don't understand. Wherever you are doing something else. So moreover, you are doing something else. It's not good like that now. Chile make a miracle.
Good evening, sir.
Good evening.
The A part, the one of how we arrive at 1,350,1350 is clear. The first step, I'm pleading. The second step is still. I
What
think
what
people have
what
asked
is
it.
the what? How do we normally determine the market price using the PE ratio? Share is earnings per share. Is that not so? Earnings,
Okay.
earnings of the company times the PE ratio. Is that not so? I've explained that whenever you are given something like this is the step. This is what you need to do. The combined
Excuse me, sir.
company. Wait, let me talk now. I'm still talking.
Okay, sir. Hello.
Apologies, sir. Please continue. Sorry, sir.
Whenever you are faced with, and some of you will be joining it, we'll send link that class will start by this time. You will now join at the middle. Then you now take us back that you did not understand how they arrive at this. If I want to ask question now, do you join this class when we start? It's unfair now. So I think that is what I need to do. Whenever anybody that wants to ask question, I have to ask the person, did you join the class when we start? Because we would have established that background.
Sir, please don't be annoyed. It's understood, but the problem is in step 2, you stated that determine the value of the target company. But when we are starting the calculation here now, it looks as if it is the main company system. That
Yes,
is where
yes.
I'm confused. Now you come. Thank you very much. It's now we cannot change it. Thank you very much.
Thank you. So the analysis here is you are given the profit after tax of the combined company, the synergy, the profit at which it will give you, right? And this is the earnings. We should not forget how we normally determine the market price or market value. So if you want to determine the market value of this, just like we have PE ratio and want to determine the market price, is it not PE ratio equals to the market price times PE ratio, market price is equals to PE earnings per share, which is profit after tax, times the PE, will give us the value. And we are talking about the market value, not per share. And that is the reason why you are given 75 million, which is in value. When you multiply it by the PE ratio, we give you the market value of the combined company. Then when you look at it that, oh, this is for the combined, remove the value of Leke. When you remove it, it will give you the maximum amount at which the company will pay to acquire our KPSC. That will be the maximum. Right? That will be the what? The maximum. You see, all those methods that we've been using, we just use the asset-based method. What is it called? The liquidation method, the this method, the other method. That is the minimum price at which they can pay to acquire, if it is acquisition, if it is this, if it is that. That is the minimum price that they can pay for that. That is the minimum price. Now, in a situation whereby the revenue, the earnings of the combined company is not given, what you need to do is add the profit after tax. Go and check your income statement of each of the company. The profit after tax minus preference dividend will give you your earnings plus the second company. Look for the profit after tax, add them together, multiply by the average PE ratio given to you in the question. We give you the market value of the combined company. Right? We give you the market value of the combined company. So, is that clear, please?
Yes, sir. Thank you, sir.
You're welcome. So the B part is what price? Now, KPLC now. What price are KPLC shareholder likely to accept? Do you know what the KPLC we want to accept? They want to accept it based on their earnings, based on what they have, based on their value, based on the company value. Just like the way we normally do, the market price equals to the PE ratio times the earnings. But this is value class, the market value. So what KPLC will accept is based on the market value, based on the market value of the what? Of the company. What they worth, the value of the company. So B Okay. B. Oh, where's that? Oh, okay. The B part of the question says that the price, class, the price here is the minimum, is the minimum price that KPLC can accept, or the minimum value, and the minimum value of which they can accept. You just come to your earnings, the PE ratio of the target company. When you multiply by 20, we give you the market value or the market price, or the minimum market price that KPLC will be willing to accept. That will be the minimum amount. Why the maximum amount is the first one we calculated based on the combined. So you can use this as the minimum price or minimum value. We should not forget that this is the concept. Earnings is profit after tax divided by the market price, right? Now, the P ratio, we can have the market price or the market value equals to, what is the earnings? What is the earnings for KPLC?
20 million.
20 million. Right? We can say earnings of K times the P. So we have the 20 million times, let me use this to be market value because it will give us in value, not per one. So times, what is the PE ratio of KPLC?
15.
15.
15
15, not in million. No, the 15 is not in million. PE ratio is
Yes,
usually in
yes.
percentage. It's usually in percentage. Or they just give it like 15 like that. Just use it the way it was given to you. So when you multiply, what do you have?
300.
300.
300 naira million, right? So the minimum amount at which KPLC will be willing to accept minimum at all. They don't collect money at all. They will collect up to 3. So they will evaluate it based on PE ratio. And it is based on PE ratio, the value of the company. You see, the asset base you use, the dividend yield you use is the minimum price. Is the minimum price. Their minimum price. The PE ratio you use, their minimum price. But in a situation whereby you have a combined company and they say, oh, what will be the maximum amount that this person can pay? So definitely you need to add, if the earnings of the combined company is not given. If the earnings of the combined company is not given, you need to, what is their earnings or what is their profit after tax of each of the company, add it together, multiply it by the average PE ratio given to you. They will give you average PE ratio. That will give you the market value of the combined company. Right? That will be the market value of the combined company. Right? So just remove the value so that we have the amount at which Lekki PLC will be willing to do what? The maximum amount they can pay is 350. These people, if the minimum amount at which they can accept is 300. So we are done with these questions. So any question, please? You can see that the concept of PE ratio, right?
Hello, sir.
Yeah, I'm with you.
Sorry, sir. Can you hear me to scroll down to see the working from step 1? That's what I just need.
So, what's next? On the hotness. You can check it on YouTube. Maybe after this class, you can quickly check. You get. You can quickly check the question. Okay,
Then can
lastly,
we have the
before
material too?
I've mentioned that now. I say you will get it. You will get it to.
Okay, sorry, I didn't hear. I didn't.
Thank you. Okay, which question? Okay, question 5. Illustration 3. So when we come back, we'll solve this illustration 2. Yeah. Illustration 2. So let's check on this illustration 2, illustration 3. What is it required? Okay. Please, can someone read for me?
Yes, sir.
Oh,
Required.
I'm coming. The required, sorry. Maximum price to be paid for targets TK, target PLC. And that's it. Okay. So this is required, right? The maximum price to be paid for target PLC, right? For target PLC. Now, are you there?
Yes, sir. Can I start reading?
No, don't worry. Your background is noisy. Don't worry. Who is that now? Please, can the person mute his or mic? Okay. TKPLC is considering purchasing the entire share capital of Target PLC. Right? Of Target PLC. TK operates on a 5-year planning horizon and believes that Target will be able to generate operating cash flows after deducting funds for necessary reinvestment of 1 million per year before interest payments. TK believes that Target PLC can generate this. Is that also cash flow? And don't forget that we have different method of valuation. Is that also the asset based, the income based, the dividend valuation, and what class? The dividend valuation and what? The last one is what?
Income.
Income based.
Discounted cash flow.
Target cash
That-
flow.
Discounted
Capital asset pricing model.
Discounted cash
the
flow.
disca- the the, dis- the
Discounted cash
discounted
flow.
the discounted cash,
Discounted.
right? The discounted cash flow. Now, you can see as you read this question now, something should just come to your mind that this question is pointing towards discounted cash flow. It is not talking about accounting profit, right? It's not talking about the first question you just read that, oh, Target, don't forget that TK want to acquire everything of Target. If you want to acquire everything of Target, they are now looking at, oh, Target will be able to generate cash flow. Because what you will pay to acquire Target, it is what you are expecting that Target will generate for you. Class. If you want to acquire company Z 100%, what you will be looking at, it is what this company will generate for you in the next 10 years or in the next 5 years. That will be the maximum amount that you'll be willing to pay. Because if it's not generating anything, you just say, oh, the value is, how did you arrive at the value? It is the cash flow that is being expected. That will take us to the free cash flow part of it, but it is not covered in your syllabus, right? But it is cash flow returns. And it is 1 million per year before the interest and anything that has to do with cash flow. Does not include depreciation or interest, because we are talking about cash flows. Just like your MPV now. Did you use interest, depreciation in your MPV? No. Is that not so? Now, cash flows, 1 million per year. The following information is also relevant, but has not been included in the above estimates. They've not included it in what they will actually generate. One, Target's head office premises can be disposed of and its staff can be relocated in TK head office. This will have no effect on the operating cash flow of either business but we generate an immediate net revenue of 2 million. That is another cash flow. For Target, that is another cash flow. If Target will generate, if TK believes that Target will generate 1 million, is that not so? Now, in addition to that, if they dispose of this office premises, they can relocate some of these staffs. So TK and the revenue will form part of what TK will pay, which is the revenue of what? 2 million. Don't forget we have the cash flow and the sales of head office, right? Synergistic benefits of 200,000 per annum should be generated by the acquisition, meaning that in that acquisition there will be a benefit of acquisition. And what is the benefit? 200. First, they will generate net cash flow, operating cash flow, net. 2, they will have to sell the disposal of office premises, cash flow. Is that also sales of disposal of head office will becomes a cash inflow? 3rd, there will be a synergistic benefit of 200,000 per annum should be generated by the what? Acquisition. There will be another cash inflow as a result of the what? Acquisition. 4, Target has loan stock with a current market value of 1.5 million. In issue, it has no other what? Debt. So there is a loan stock here. When you want to, of course, when you want to do your cash flow, your loan stock will not be part. It is not a loan. It is not a cash item. Leave it one side. It is not cash flow of IS7. No. Please, it's an investment. Budget has loan stock. There is a loan stock which has a current market value of 1.5. When you, it is not part of cash flow. It is not. It is a what? It is the company debt. TK estimates that in 5 years' time, of course, when you want to acquire a company, you have to do a background check. Are they owing? Who are they owing? Who are the directors? Who are these? So that you not go and enter then start paying for debt. TK estimates that in 5 years' time, it could, if necessary. It could, if necessary. TK now say, oh, if I acquire Target finish, I can dispose it of Target for an amount equals to 5 times its annual cash flow. That would be the disposal, meaning that if I acquire Target company now, I can sell it to in 5 years' time. That is at the end of 5 years. Dispose of Target for an amount equals to 5 times its annual cash flow. 5 times annual cash flow. Plus, TK believes that a working cap, a WACC, and this WACC of 20%, don't forget, class, WACC is weighted average cost of capital. Is that not so? that considers the sources of finance, both equity and debt. So your average sources of finance, both equity and debt, is equals to what? Is what 20%. Reflects the risk of cash associated with the what? With the acquisition. Calculate the maximum price to be paid for targets. Ignore taxation. Class, who did you want to prepare this maximum price for? It is for who? It is for investors. It is not for a company. It is for investors. Meaning that investors who want to buy the target company, which is what? The TK. Right? Which is what? It's TK. Class. So we need to consider all the relevant cash flows. All the relevant cash flow that will arise as a result of acquisition. Cash flow, class. Then, if we consider all the cash flows, we can now do what? We discount to get our present what? Our present value. Now, suggested solution. Suggested solution. What is the name of the company? To be paid for targets. Determination of maximum price to be paid. Maximum price for targets by considering all cash flow that will arise from the acquisition of targets. Class, are we still together, please? Are we still together?
Yes.
Yes, sir.
Okay. Now, this cash flow is for how many years? Don't forget that this person will now dispose it. TK estimates that in 5 years' time. So since it has estimated that in 5 years' time, I will dispose this assets. I will dispose target the other company. When I dispose it, then I will have a cash flow. Is that also a disposal in 5 years' time? So you can estimate this to be 5 years. Class, you can estimate this to be what? To be 5 years. Class, are we still together? 5 years.
Together, sir.
So we can have year 0, year 1, year 2, year 3, year 4, year 5. You see the reason why I use year 0. This is an interesting topic. Just pay attention. Okay. It's a million, right? Okay, let's do like this. So ideally, we are not supposed to have year 0 here, but because of, or let me remove it. Let me just remove this. Let me remove it so that you know that it's not supposed to be like that. Now, what are the cash flow? What are the relevant cash flow? First one is operating cash flow. After deducting funds and necessary reinvestment, I have the 1 million. And what is the 1 million? The 1 million per annum. Class, when you are faced with a question like this under the discounted cash flow, what you need to do is consider all relevant cash flow that are associated with either the acquisition or merger. Class, all relevant cash flow that will arise as a result of the acquisition or merger. So operating cash flow. Operating cash flow, 1 million per year per annum. So what other cash flow do we have? What other cash flows do we have, class? On my figure 1, right?
Sales of disposal.
Sales of disposal. Class, target head office premises can be disposed of and its staff can be relocated in TK's head office because of the acquisition, and they will have to generate something from that, right? Sales of what? Cash flow arise from disposal of head office is a cash flow. Cash flow from head office or disposal of head office, which is 2 million. Now, they didn't tell you that they'll be generating 2 million every year because they say they dispose it. If you dispose it, is one off. Is that not so? When you dispose it, it's one off. Now, my question to you, to everyone, is how do we now treat it? Are we going to put it in year 1?
Put it in year
Year
5.
5. Year 5. End of the year.
Yes,
Why?
sir.
Why? Is it at the end of the year they will dispose the assets?
It will be from year 0 because it says that it will generate an immediate net cash flow, cash revenue.
Okay.
Size 0 because the activity has not yet commenced.
Thank you. And that is it. We've not commenced anything. Immediately, we say, okay, we've not even started anything. We just say the head office premises can be disposed of and its staff. They did not say at the end, though. You know, if you want to acquire Kudus now, it is not that at the end of the 5 years that you are expecting that this person will have this. Will you not dispose it at the end of 5 years? You want to acquire the company now. You dispose immediately. It's immediate. Right? It's immediate. It is not at year 1. It is not at year 5. It is at year 0. because it is immediate and we will not even start anything at all. It is immediate. You can't put it in year 5. Why? Did they say they will dispose it off at the end of the 5 years? No. It is immediate, not at the end. And they didn't even state that, oh, it is per annum. So you can't put it in year 1. So it will be in year 0. So we can have it. Oh, okay. Let me see if I can manage this first. Oh. Okay. Okay. Year 0. Sales on disposal of head office. We have 2 million. Is it 2 million?
Yes, sir.
Okay. What else do we have?
Synergy
We
benefit
have
of the decision.
Sir, any
Synergy
disposal of
benefit.
head office or disposal of assets for a
uh,
premises.
head office assets. What do you dispose? Put it there. Is it not head office premises? Is head office premises? You can put it there. Disposal of head office premises. Fine. You can add premises. Right. Or disposal. Or cash flow arise on disposal. So just disposal of synergistic benefits is an inflow, cash inflow that will arise from, and it is occur. Can you see? 200,000 per what, class?
Per annum.
100,000 naira
Yeah.
per annum.
200,000 per annum. Can you see it? 200,000. What are other relevant cash flow? What do we have again? Is there any other
Loan
cash
stock.
flow? Is loan store cash flow?
It's not a cash
No,
flow,
no,
but you
no.
ask us what we have again.
So it's not, it is a debt now, right? That's no what other debt. So this is the debt they have, right? It is not part of cash flow, right? That we need to consider here, right? When it comes to acquisition, yeah, right? But we'll still consider it as we move. Now, my point here is the next one. What's next?
We
What
have
next one?
disposal
What next
of
one? What next one?
disposal of
Four.
Note 4.
target
Note 4.
the disposal of target PLC.
Okay, thank you. The disposal. And the disposal will be disposal. Now, the disposal will be what? 5 times. 5 times its annual cash flow. Class. 5 times it. What is the annual cash flow? What is the annual cash flow, class?
1 million.
It's 1
1
million.
million.
It's 1 million.
1 million.
1 million. Right? That in 5 years' time, if necessary, in 5 years, so dispose of targets for an amount equal to 5 times in 5 years' time. 5,000, right? Right? Class, are we still together?
Yes, yes, sir.
Now, so we need to add all this together. You have total cash flow, right? So this is 2 million. This is what?
1, 2.
1,200.
1,200.
The same thing, 1,200.
1,200.
1,200.
1,200. 1,200.
And this will give us
6,200.
6,200.
Okay. Now, we need to discount because this is what this will give us for 5 years. What will be the present value? What will be the present value of all this? What will be the present value? Class, what will be the present value? So we're given the weighted average, class, and this weighted average includes both debt and equity. Is that not so, class? Is that not so, class? Hello?
Yes, sir. Yes,
Yes,
sir.
sir.
Yes, sir. Yes,
The
sir.
list of the cash flows associated with the acquisition. Yeah.
Yes, both debt and equity. Now, what will be the DCF for the company? Is 20%, right? So this will be 1. What do we have here? What is it?
0.833. 0.694. 0.579. 0.482. 0.402.
Forwards.
402.
Okay.
1,000.
1,000.
Yes, 1,000. 833. 695. 578. 2492. 2492.
Okay. What is the total value of the company?
That's 7,598.
Total market value of the company. What do we have?
7,598.
Right? Now, class, this answer that we got here would have been the total maximum price or the maximum value that TK will pay for Target PLC. But guess what? The total market value we have here is for the company. Is for the company. When I say total market value of the company, it include both equity and debt. Is that not so, class?
Yes, sir.
Class, it include what? Both equity and debt. The weighted average cost of capital you use to discount it, it includes both equity and debt. And that is what gives us the total market value of the company, just like in our cost of capital. Because your work, you use work to discount it. That is, any value that you have will be the total market value of the company, which include equity and debt. But do we need the part of debt? TK is considering purchasing the entire share capital. Entire share capital. What we need is the market value of the equity, not total. Because what they want to acquire is the entire share capital. And when you acquire the entire share capital, you have become an investor, equity investor. Class, am I communicating? When you want to acquire the entire share capital, and the total market value we have from our calculation include both equity and debt. Class, you should not forget that total market value is equals to total market value of equity plus total market value of debt. And this is the total market value of the company, which include equity and debt. But what we need is only the equity, because what they want to acquire is equity, not equity and the debt. Is the share capital. Class, am I communicating, please?
Yes, sir.
Now, we
Yes,
should
sir.
have just say, the total market value or the maximum price is 7,598,000. But because what they want to acquire is share capital, which is equity, and you already use weighted average, Class, are we still together? Excuse me. Now, in a situation whereby you are given the cost of equity, class, pay attention, oh, please. I didn't mean you are given the cost of equity. The total market value here will just be total market value of equity, and that will be the maximum price or the maximum value that TK will be paid. We'll leave it like that. And then you were given the cost of equity to discount. The reason why the total market value of the company include equity and debt, it is because you use weighted average cost of capital to discount, which include equity and debt. So when you're given the cost of equity, what you have as a value is the maximum price, is the maximum value. But when you're given the weighted average cost of equity, weighted average cost of capital, it includes equity and debt, meaning that the total market value of the company you calculate include both equity and debt. So you need to get the one of the market value of equity. So we can make total market value of equity the subject of the formula. So total market value of the company is 7,598 equals to market value of equity, which is unknown, plus now total market value of debt. We are given a debt in this question. Is that not so? What is the debt?
Yes, sir. 1.5 million.
Stop. This is the current
1.5.
market value. Can you see market value? Now, in another case scenario, don't worry, maybe the next two classes, I think the next class, then in our intensive, I'll bring another question that has to do with something like this under the discounted cash flow. Now, we have 1.5 million. They say current market value. In another case scenario, the examiner will want to test your knowledge of cost of capital, whereby how do we normally determine our market value of a loan stock? You will now check the statement of financial position, where you will now have the value of the debt, right, divided by the nominal, right, times the market price. We give you the value of that debt. So examiner may want to test your knowledge on this. So take notes. So get yourself prepared in valuation of a business. That, okay, if it comes this way, this is how to apply. This is, so you don't need to stress yourself. How do I get, oh, we're giving weighted average cost of capital to discount. Oh, that is the total market value of the company. Okay, what are the value of debts here? They may give you different debts. So you need to look for the value. Add all the market value of debts together. It becomes your total market value of debts. So class is 1.5 so therefore market value of equity is equals to market value of equity equals to we can remove this. Okay, let me do it this way. Okay, let me do it this way. So that it will not look somehow. 7,598 minus 1.5 equals to. So therefore, what is the difference?
6
That was about
6098.
98,000. 098.
098.
Then 3 zeros.
So this is the maximum price. Therefore, the maximum price (098) plus. Is interesting, right? Is it interesting? Plus. Hello.
We are with you, sir.
Yes, sir, we
Okay,
are with you, sir.
so this is what we have.
We are with you, sir.
So we are done with this question. Right. So when you are faced with a question on discounted cash flow, consider all the relevant cash flow that is being associated with the acquisition or merger. Then check what is given to you. Is it cost of equity or weighted average cost of capital? If it is cost of equity, it means that will be the total market value of the company, equity. But if you're given the weighted average cost of capital, it means that your total market value of the company you calculate includes both equity and debt. So therefore, you need to check from the question, does the company want to acquire both equity and debt? That is another question. Did they want to acquire both equity and debt? Most times they only want to acquire the shares. Most times they only want to acquire the shares, and the examiner will want to test you and give you the weighted average cost of capital to discount. Once you discount, we give you the total market value of the company, which includes both equity and debt. So therefore, you cannot make it the subject of the formula. The total market value of debt may not be given to you. You have to calculate the total market value of debts in some question, right? That will be the maximum price that you will now be paid to acquire that particular company. So that's it. Thank you. So I think I need to go now, right? Chinemere Miracle, quickly, please. I want to go.
Sorry, sir. Please, my question is this 5 times if it's disposed, I didn't see where it's treated, or we just ignore that statement.
You didn't see where this is it now. This is it now. 5 times. This is it. Can you see it?
Okay.
5 times annual cash flow. And what is the annual cash flow? 1 million, right?
You can see. I didn't see, but I didn't add it up now. Thank you. Thank you.
Thank you. You can see how you can see look at how cost of capital is very, very important. Imagine you don't understand cost of capital. How do you want to solve it? How? Just tell me how. Imagine someone want to take you class now, just start with business valuation. Everything will just look how now, right? Someone who did not understand the cost of capital want to understand the what is it called, the valuation of a business. It is not possible, right? And that is why I have to treat it like this, right? So thank you so much, everyone. So you have to go back over it, go back again, check it again. It's on YouTube already. Then I will send the material on or before the next class. So do we have anyone that have question?
Thank you, sir, for the class.
Okay. Do you have question? I don't receive.
Not
Thank
really
you.
a
Thank you.
question. Not really a question, please. I want our next class. I want to see the IB I know, not this one.
You say you want to see it. Keep playing.
I said thank you.
Keep playing. But this one is not. No. See, let me just say the two. It's somehow now, right? It's somehow whereby you've explained something and someone just come middle, say, do you understand? It's somehow, right? And I feel that I've explained to the best of my knowledge. Do you understand? I feel that I've explained to the best of my knowledge, and that is the reason why sometimes it's somehow, right? But that's fine. So, see you in our next class, right? So in our next class, right? In our next class, in case this operating cash flow, maybe examiner want to change their mind, right? Rejoice, thank you. So if examiner want to change their mind, right? This operating cash flow, how you can arrive at operating cash flow, right? Maybe in our next class, we'll just have a brief discussion before we look at illustration two. So thank you so much, everyone, for joining. And see you at 8:30.
Thank you very much, sir.
Thank you, sir.
Thank you very
Sir,
much, sir.
sir, we
Thank you,
don't send
sir.
we don't send Hida rice
God
for you to
bless you.
Lagos, so to
You
Abuja.
don't send anything. Come on, I don't see anything for Abuja here.
No,
I'm
not
waiting.
you
You
come.
Abuja.
You come, DHL, you come DHL. Eh?
Abina. All right. Thank you.
All right, sir.